Hi everyone, hello from Singapore. Thank you for taking the time today to join us for our event on explaining deep tech fundraising in Southeast Asia, presented by SGInnovate and Qualgro. My name is Jody from SGInnovate, and for those of you who may be more new to us, we are a government-owned organization in Singapore with the mission to build deep tech innovations from Singapore for the world. We invest in and help build deep tech startups in the fields of artificial intelligence, medtech, quantum tech, and autonomous vehicles, to name a few. We also work with entrepreneurial scientists and clinicians to help build their innovative research from lab to market and develop deep tech talent, as well as engage with a vibrant deep tech ecosystem. Part of our initiatives to strengthen the deep tech ecosystem and generate conversation and knowledge sharing is through community events such as the one we have today. Today's webinar will involve an exciting panel of speakers who will dive deeper into the mechanics behind deep tech fundraising in Southeast Asia. Without further ado, I will now pass the time over to our moderator, Maria, to start the session. Maria, please.
Thanks so much, Jody. Good morning, everyone, and it's great to be with you all. I'm super excited about our topic today because I think it's a really important conversation to have, but one that doesn't quite get enough airtime. So I think we know that the fundraising process for any startup can be quite challenging to navigate. Investors generally demand to see increasing growth, strong unit economics, solid retention amongst customers. However, I think you take all those challenges and you apply to the fundraising process for a deep tech startup, and then you layer on the extra bit of long R&D timelines, commercialization opportunities, and frankly, sometimes a mismatch with investors as well who are not quite as familiar with the technological aspects. So today's panel will deep dive some of these specific issues around deep tech fundraising and explore some of the challenges and lessons learned from both the founders as well as the investors' perspective, so that the other deep tech enthusiasts on the webinar today can help navigate the process a little bit more effectively in the future. So on our panelists today, we have 4 esteemed speakers. First up is Sinue, the founder and CEO of Tiger; Wei Shen, an investor at Qualgro; Ansem, the head of corporate venture at Philips; and Victor Tan, the director of venture investing at SGInnovate. My name is Maria, and I'm the CEO of Tech in Asia, one of the leading digital media publications that covers Asia's tech and startup scene. We do have a Q&A tab as well on the side, so please do use that. We'll go through as many as we can in the flow of the conversation, and also set aside just a few minutes at the end of the session to make sure we cover all the questions. All right, without further ado, let me ask the individual panelists to please introduce themselves, their organization, a bit how they got into deep tech and experience with deep tech investing or deep tech fundraising so far. Sinue, can we start with you, please?
Sure. Thank you so much, Maria, and SGInnovate for having me in this most interesting panel. My name is Sinue Arroyo. I'm the founder and CEO of Tiger. Tiger is a deep tech AI company headquartered in Singapore. We are currently 150 plus people spread around 5 countries, including business in Russia, Middle East, Spain, where I was born, and in Mexico. Our focus is information access and information extraction. We market a platform for reading, extracting information from documents, also a chatbot and a search engine, all are conglomerated into that platform. We completed Series B last year, and had not been because of the pandemic. We're very well on our way to do Series C. Of course, that had put all those plans on hold. We don't see any appetite from any investor really to deploy capital at this time. So yeah, we have a bit of experience in the space. We have fundraised here in Asia, but we also have investors from other parts of the world, including the US, Mexico, Spain, different countries, right? Yeah.
Great, thanks. Ansem, maybe if we can turn to you.
Sure, thank you, Maria. And good morning, everyone. So my name is Ansem. I joined Philips 4 years ago to build our corporate venturing operations and program in the region. Philips is a health tech company. We are based in over 100 countries with a global vision of making the world healthier and more sustainable through innovation. Our goal is to improve the lives of 3 billion people a year by 2030. We set up in Singapore in the 1950s, and since then we reinvented ourselves. We've moved from televisions and radios to health tech. Our team operates as a focal point at Philips for external early stage innovations. We identify, invest in, and work with tech companies to complement Philips' assets and drive improvement in health systems. Delighted to be with you today.
Thank you. Wei Shen, maybe we can turn to you.
Yeah, sure. Thanks, Maria. And good morning, everyone. My name is Wei Sheng, and I am an investor at Qualgro. We are a fund based in Singapore, and we have a focus in B2B startups. And in the course of investing in, I guess, B2B companies, we come across companies with a deeper tech focus, and have been quite fortunate enough to invest in some companies with such a focus. So, across our portfolio, we have some deep tech companies, among them robotics companies and companies in artificial intelligence in certain specific sectors. We are quite early investors, investing in Series A and B, but also have made some investments at the seed stage. The most recent deep tech investment that we have made is a company called Hivo, which is a company that does data pipeline. This is an innovative solution for extracting and transforming data across multiple data sources in real time with full automation. And we continue to want to invest in deep tech, and therefore is very excited about this panel today.
Awesome. And Qualgro is obviously an event partner today, so thanks for that. And then last but not least, Victor.
Thanks, Maria. Hi, everyone, and thanks for joining us this morning. So I'm Director of Investing here at SGInnovate, and my job is mainly to look over all the investment pipeline that we see, and to the due diligence and execute on the deals with the team. I've been very fortunate to have been a part of SGInnovate since its inception, and I think the past 3 years have seen our space, and our areas of interest in deep tech grow at a reasonably astounding rate, and I'm happy to share all the stories that we've seen since then. So happy to be on the panel.
Great. So let's jump in, and maybe establish kind of a common baseline and understanding for deep tech startups before we, dive into the actual fundraising aspect of it. So in your opinion, what is actually different about deep tech startups beyond the actual technology? And then we'll talk about it both from a founder's perspective as well as the investor's perspective. So anyway, from a founder's perspective, what do you think is the primary difference?
Well, the primary difference is probably the fact that you are building an asset that creates a significant barrier of entry, right? If you are able to understand the technology deeply, therefore you can create something that is beyond the reach of the majority of the public. This is in stark contrast, and that fits very well also typically with B2B, but also not necessarily. But the behavior of the consumer, how you make the decisions, also plays an important part on the aspect of the technology, right? You have a solid base, a deep tech base, you are creating a much stronger barrier of entry. There are some challenges to that because building that asset requires more investment than building something that is not deep tech. You need very strong talent, very knowledgeable, capable talent. I always say that deep tech or technology is not really about the technology itself. It's about the people that creates the technology. Without good talent, without good people, there is no technology. Technology is a byproduct, right? So yeah, I think that probably characterizes the space quite nicely.
To my investors, anything you'd like to add onto that?
Sure. I think there are several differences, about deep tech startups with general tech other than the tech itself. Assets to begin with, bulk of the value in deep tech startups may be in intangible assets. So it's useful to understand, to investigate and evaluate what sort of, for example, registrable IP there is in the company. This could be, for example, patents for invention, what economic opportunities are associated with such assets. But other assets, if you think about the medtech space, could include clinical trial data, analysis against, the current gold standards. So assets certainly is one aspect. Others would include the team formation. In founding the company, you would generally find that tech and scientific talent forms, an important backbone of the startup itself. And finally, I think from the investor's perspective, one thing to be mindful of is the time to commercialization. We are talking about usually several years. It could be 5, it could be more than 10. In general, I think exits take longer as well. If we look into the space of medical technologies, it requires a longer gestation because of several things like development, testing, clinical trials, ensuring safety and efficacy and performance.
Yep. And I think just to add on to what has been said, so I think the longer gestation period, as Ansem has rightly pointed out, is a key characteristic, right, of deep tech investments, and that's what makes it so risky, and why there's so few of us who are actually doing investments in this space, and IP as a form of defensibility of the business, is extremely key, because that's all the company is built on in a deep tech kind of like environment. The one other thing that I would add on is also kind of like the different growth trajectory and exit paths, that a typical deep tech company would need to go through. Right, so it's kind of different from folks who are doing like consumer and just pure enterprise SaaS. I think within this space, the problem is there are not enough people who understand the actual trajectory and who have the actual networks and relationships to make that happen for the companies. Right? So I think that's one. You need knowledgeable investors and organizations to work with in order to grow, to think about your longer path, right? I think that's kind of like the one of the things that we believe is still a big challenge domestically in the region, definitely, and globally there are definitely more people who can pick up on the investments.
So Wei Shen, you mentioned that Qualgro obviously is a bit of an early stage investor, and then specifically an early stage investor in deep tech, which we've already discussed has very long timelines. So can you talk maybe about some of the risks and the decision making that goes into staking out the position for the fund that you guys currently have?
Sure. So first of all, I completely agree with the long gestation period and then the I'll say like the mindset towards investing in deep tech, because you need to have that before you even endeavor to start to look at this sector, right? And to the question, what kind of so your specific question was more around the risk, is it?
Yeah.
Okay. I guess from a risk perspective, there's the risk rewards assessments are always quite controversial, I think, to articulate. So I will try not to dive too deep into this one. But as you can imagine, it is a function of probability of the vision, as we layer in many different scenarios in between, and of funding, of entry valuation. So I'll try and talk from the perspective of how maybe a private VC might manage risk. And I think there's no point, first of all, there's no point trying to have, punishing terms like, multiple times of liquidation preference and things like that. First of all, the startup doesn't have money to pay you in the event of a liquidation. So there's really no need to get into all those details. And actually, you might want to back this founder again for his or her next venture. So it's great to keep that relationship strong. I think one way we manage risk is also in terms of tranching. In deep tech startups, the milestones that you're looking for are not necessarily the same as in consumer startup, like Victor mentioned. You are looking for a technological improvement, and this technological improvement may not come in leaps and bounds; they may come in steps. And so the kind of funding that you put in should be commensurate with that. So there's no point. Or rather, I see a very little point in investing large amounts behind deep tech, unless it's necessarily warranted. But you want to see incremental technological milestones, and therefore I think tranching in terms of funding can come in quite helpful to align interests, because then when you do that, you kind of encourage the team to be focused on goals as well. I guess the other ways we manage risk is also managing IP risk. I think Ansem touched on this point. And also basically managing and aligning with founders right from the get-go. I wouldn't lock in founders on contractual terms, but at the same time, you want to work well with founders and have a good relationship so that they're not unhappy and leave in the middle of an investment. I think this just makes for higher probability for success.
For sure. All right, so we've touched on milestones and I think tranching a little bit, but maybe let's take this conversation from through a founder-investor relationship and the actual journey, right? So let's talk about that very first, the initial introduction and the pitch, And from a founder's perspective, as well as the investor's perspective, like kind of what are you looking for? Like what's the chemistry that you're looking for? From a founder, how do you know like this person might be the right fit for you? Do they understand the tech? Will they be the right partner for you along the journey? And then specifically from the investor side, like what are the main things you're looking for in that initial pitch?
Should I go first?
Yeah, go for it.
Sure.
Sorry, my mic was on. So I think first of all, as a investor, you need to be a little bit more imaginative. Sometimes we are a little bit mired in okay, risk returns assessment. But it is important for VCs to be imaginative and say that, okay, this future that the startup is envisioning is possible, and even better if it's probable. So first of all, the founder vision and your vision should align. And of course, this alignment might not happen immediately in the first meeting. It takes some education on both sides to kind of form that alignment. So I think at the very first instance, what I'm looking for is alignment in vision, what the end state could look like. And then that could change, and that's fine. And we kind of introspect a lot together to talk about our rationale, motivation behind this vision, what trends do we see, what problems or obstacles do we see in terms of adoption. I think when this event first started, there was a video, right, that came on, and I think the gentleman in the video mentioned something along the lines of one of the things to consider is the obstacles in terms of adoption. And I think that's an important thing to iron out and to understand the realities of it. What obstacles are there in terms of technical roadblocks? Perhaps collecting data is a challenge for a lot of DTech startups. So I would over-index on those things to try to form that alignment.
Yeah, and I would add to that. I think investment evaluation is indeed difficult and more complex when looking at deep tech companies. I think in the early meetings, there are a few things we look into. We would pay more attention to what I reflected on team formation. For example, do we have the tech and scientific talent to make this work? Of course, it's not only about the technical talents, but we would look, if there are capabilities around business operations, people management, to get the startup starting as well. We care about what you are solving with the technology. So it's, I think, important to understand why is the problem you are solving worth caring about, because you may be starting with a technology or an engineering discovery and not a problem. You may be looking for a solution that fits to what your discovery and tech is about. More often than for general tech companies. So ultimately, your tech is as good as its applications and the business opportunities surrounding it, which leads to the points about what your addressable market is. What is the size of the opportunity? Is it worth taking the risk of making a long-term investment into bringing this technology to the market?
So I guess I'll add on and also say that I think for deep tech, especially at the early stages, Wei Sheng is really right to say that the team formation is a key issue, right? Because generally I would say because deep tech is typically spun out of research, and universities, a lot of the early founders are all pure tech founders, right? Which is an issue, which is great. At the very early stages in terms of creating the idea, coming to a prototype and actually getting into some early trials and all that. But it is terrible, to have pure tech founders when you're starting to grow, right? To find the product market fit, speaking to partners, and eventually scaling. I think so. The team itself needs to be of the right composition, and they need to have the right mentality in terms of understanding that there are limitations to what they can do. And you'll need stronger people, right, to be able to help them to grow even faster. So I think there are some of these. It sounds very rudimentary when we speak about it, but when the founder is so invested in his startup, there's a bit of that, right? There are very few tech founders, that can actually scale so big. SGInnovate is one of the rare ones that we know, right, that has been able to do that. But generally, I would say based on our experience, that has been one issue. Overall, the way we look at the companies it will fit into the standard in the investor kind of like categories, right? Addressable market, right? Which is it real? Is it, is there, and when you talk about addressable market, it's not the usual bullshit about how big the market is, blah blah blah, right? But it's actually, what is the actual application within that huge market you're talking about? And sometimes it's not real, and sometimes they have no way to get there, right? So I think as investors, that's our job in being able to say, hey, maybe I can get you to this particular spot where you need to address the right market, right? And usually, if it's a pure tech founder, a startup again, they won't know what the addressable market is. Usually, it's just part of the story. IP, of course, is part of one of the assessments. I think the actual product, the actual product itself is usually a dream, So we're talking very big generalizations, and I think Wei Sheng is right to say that when you start out, you need to be aligned in terms of the vision, because the actual application of the vision is a bit different, and it will keep evolving and changing, but the vision usually stays true, right, in terms of what you want to achieve at the end of it. And I think as investors, we need to be able to go with the flow, and roll with it, lah. Then we think about the kind of like the same thing, competitive advantage and differentiation, of the product with the rest of the other products. In this case, it's a bit harder to validate, right? Because typically within deep tech, all the individual areas are so specialized, and the guy who's doing it is probably a genius, right? So there are not that many other geniuses that can debunk the genius. So then we are definitely not geniuses, right? In that sense, because we look at a reasonably broad spectrum of investments. So how do we tell if this genius is really real, right? I think and then from then we can figure out if his actual competitive advantage and differentiation is for real, right? And then later on we talk about, as they start to scale, we think about the business models. Is it real? Typically for deep tech startups, there really isn't much of a business model beyond going into working with a large industrial, a large partner, right? Which is the next issue in terms of them being able to think about that long-term partnership and collaboration. So I think these are generic enough such that all investors will look at it. But I think in our area, we tend to be a bit more problem when it comes to the actual applications of the individual categories. Yeah. So I'll stop there. Thank you.
Okay, so Sinue, as our unicorn deep tech founder, with both the tech side as well as the commercialization side, and
unicorn to be. Unicorn to be.
And
as a founder, you might be the unicorn. Your company
I have to disclaim that Tiger is one of our portfolios, so I better put it up front.
I think that was pretty clear, but thanks for clarifying.
I think Victor touched on a very important point at the end. I mean, for investors, it's very hard to understand every other startup in the deep tech space, right? And then there has to be cut ways that they have to build their comfort and assess whether the vision of the company, of the founder, whether so there are layers that they try to check in order to say, okay, this investment is worthwhile. And that changes depending on the phase that you are, whether you are in pre-seed, seed, A's or B's. The things that investors look at the end is different. It's exactly as Victor said or was mentioned before. If you're a deep tech person, and like I was, right? I hold a PhD, I was taking that research and building Tiger based on that. I know nothing about business back then. Not that I know much now, but you have to be able to make that transition. And that is a very hard journey. Either you make it by yourself and you have the flexibility of the mind to bend yourself and transit, or eventually you need to agree that you need help. Eventually, it all boils to the founder and the founding team, whether the investors resonate with that, whether especially in earlier stages where they believe this is people that are going to see this through. Founding a business is extremely hard. There is more lows than highs. And it's very challenging, right? I remember when I started the first 2 years, I had no salary, zero, right? It was just plugging through. At the end of the day, I think what matters the most is whether your company is generating revenue. The revenue is growing. Why? Because for investors, it's going to be very hard to assess the technicalities of your company. I mean, if you move into security and business technology, it's tremendously difficult. You have to really go deep and understand the algorithms. Even for us, when we say we are an AI company, people come with a machine learning package, and many investors come with, oh, this is my tech guy. And then the conversation is, machine learning versus what we do, which is AI, but it's a different branch of AI. And it becomes like a religious discussion. Like if you're a Muslim, I'm a Catholic, I'm trying to convince you that my take is better, right? So we completely cut through it. Maybe the example is not very good, but I think it's very graphic. But then we cut through it says, and it's not really about the technology, it's about this problem that you solve, where you are able to solve it better than the rest, whether your company is scalable, whether you are generating revenue, and there is a path that if they put more money, you are going to continue generating even more revenue. And nowadays is where you have a path to profitability. That has become extremely important. No one was talking about that. I mean, not so much. For us, it was grow, grow, grow. We doubled revenue every year. Everybody was extremely happy. But suddenly, the markets for fundraising dried up, right, overnight with COVID-19, especially for big tickets. So you have to change your model. If you are hyper growth, you also are going to need a lot of cash. If there is no markets available for fundraising, and it is the case now. I mean, many investors are saying, yeah, we're investing. The truth is no one is moving. It's a herd environment. When the thing resumes, it resumes for everyone. And then you have to change your model. So we did that. We didn't pivot because the business model is the same, but we changed the model of the company. And I was okay, by end of this year, so much part of the business will be profitable. By the end of the year, the whole business will be profitable. Which in essence, I mean, they are all talking about sustainability and profitability. I think this is not really the right way for investors or VCs to go about this. The typical return of a VC fund is 10 to 20% average. And that is in an environment where valuations are growing very high and exits are happening. Now, if you move into an environment where valuations are depressed, there's not much fundraising, I think the performance of VCs are going to be very poor. Of course, this is really not going to happen because the market will resume eventually, and there's so much liquidity out there. And eventually, all the money that is in the capital markets will start to flow back in there. But it's just interesting reflection. For me, summarizing, I think it's about how much money you are generating, how much your revenue is. And that simplifies the game for everyone, even SaaS metrics, LTV to CAC, churn, all that stuff, right? We look at all those metrics. If your numbers are good, your fundraising is going to be easy. If your numbers are not good, well, then you have to, plug through a bit more the vision, the mission, et cetera, et cetera. Yeah.
Okay, a lot to unpack there. But let's okay. So it sounds like, if I can summarize, and just anybody can jump in, but at the seed round, it sounds like definitely founder vision, I think company vision and mission matters the entire process, the entire way through, right? So it's just about how close you're getting to that and how you've had to adapt. But at the seed round, it sounds like founding team is one of the most important questions. At series, anybody can correct me as we go. At Series A, of course, the team matters, and then maybe you can start to show revenue at Series A.
You have to. I don't think in Asia anyone is going to invest in, any VC is going to invest in a company that has no revenue in Series A. I say we have a great team and look what we built. It's irrelevant. It's really about the problem that you're solving. That might happen in the US. That might happen. You have this massive amount of technology, no revenues. And some VC comes in here, 20 million, 100 million, fantastic. I have never seen that happening in Asia. And I don't know, maybe the VCs can correct me.
I think to some degree, it also depends on the sectors. For example, for life sciences and medtech, you may find technologies that are in development and therefore at pre-revenue stages. So very much agree to SGInnovate, but it depends on the sector as well. And also to highlight, I think on the founding teams, there are characteristics which we think are important, and this includes what's been reflected, for example, by Victor. While there may be a vision that will be consistent among the founding team over a period of time, that there needs to be that flexibility in getting there, whether it's through iterations or pivoting or adjustments to the solution. And also, I think what SGInnovate reflected in terms of resilience, it's going to be a long time, and there are more low points than high points. So resilience and flexibility, I think, are important characteristics we would like to see in the team.
So Ensam, if you for y'all at Philips, if it's acceptable to have a Series A, somebody's fundraising for Series A that doesn't have revenue yet, but they have like really promised technology, then what would be the alternative criteria that you're looking for at that stage?
I think at that stage, there needs to be a couple of things. One, the innovation that is being developed, it needs to be meaningful. It needs to be solving an unmet need. It needs to address or be patient-centric. So a meaningful innovation that can be sustainable for the long term. And what I mean by that is, it would be a pre-revenue stage company. In the longer term, there needs to be some view or a roadmap towards a path of profitability. That roadmap may change. That pathway may very well change. But I think what we believe is that a solution, a meaningful innovation, needs to be sustainable for it to survive in the longer term.
Okay. So that's Series A, and then Series B. What do you need to be demonstrating at Series B that's new and additional to what you've already previously demonstrated?
More growth, established business model, many production installations. It's like you have a small fire, you build a small fire, you just put more gasoline, it's going to go bigger. That's it.
Okay, investors?
So picking up on Sinue's point earlier on the fact that it is a tougher environment to fundraise now, I definitely agree. Not just in deep tech, but across sectors as well. But even more so in deep tech, I think, and definitely in the later stages of deep tech, there is indeed some sort of a little bit of herd mentality. I can't discount that. So it takes some really, I guess, difference in understanding and difference in thoughts to want to continue to invest in this sector. To that end, I think this year we've done a couple of investments, albeit in the earlier stages, so it's easier for us to make that bet in deep tech. In a few companies. One is Hevo, slightly larger round at 8 million for a Series A, which I think for earlier stage, this is actually quite a good time to invest because you can't really do much in the way of commercializing now. So if you are looking at earlier stage companies where your money is going to be put into hiring talent and building product, I think it's a great time to invest. So to that end, I think many VCs like ourselves and our other friends, SGInnovate as well, are seriously looking at this space. The other angle that I think is quite I just want to ask a question at Series B, right, Maria? Like, what else are we looking for in Series B? I think we want to back entrepreneurs coming out of Southeast Asia. There are great entrepreneurs coming out of Southeast Asia, equally as good as their US counterparts or elsewhere, right? But the key point that I want to stress here is that Series B, I think you need to have a global mandate or a global outlook in terms of commercialization. The market in SEA in Southeast Asia is not necessarily deep enough for deep tech. Adoption levels might be lower as well. So you need to have that international outlook. And and of course, in a way you're cross-country, very international. I can't say the same for many deep tech companies at the later stages that have the same global ambitions. So that's an important criteria for us as well.
Okay, so this year in particular, maybe actually extra good time to invest at the early stage or at the slightly earlier stage level. And then I think global markets have we've seen a lot of challenges, I think, this year in particular. So, but even to talk, Victor touched on this earlier. So to talk about the exit opportunities, I mean, even prior to 2020, Southeast Asia hasn't been known for a lot of great tech exits. And then so just kind of curious to hear y'all's perspective and maybe let's set aside this year, but just kind of speaking more generally, like what are the exit opportunity and paths that deep tech founders should be thinking about? Because obviously, any healthy startup ecosystem has like the actual investment and the startup and the seed and all that, and then the actual exit opportunity. So how can deep tech founders kind of navigate their different options and where should they be thinking?
So maybe I'll take a quick jump at this. So having the idea of the exit in mind is important. I think for us as a team, we believe that we need to have that idea even if you're investing in the early stage, right? Because that allows us to craft kind of like the pathway for the company in terms of their development and how we can assist them in terms of relationships and thinking about the longer market development in a much longer perspective. I would say that first, the IPO exit for deep tech company is usually, not very real, right? Especially in our part of the world. I mean, in our part of the world, generally an IPO exit is not very real, right? But for deep tech even more so, because usually deep tech related companies are typically a component to a much larger solution, and they typically feed towards a larger industrial company. So in the areas of deep tech that we look at specifically, we've realized that most of the exits for us as investors come through acquisitions. Right? So M&As are the primary means of getting our money back, and typically it is towards a larger industrial. In the biotech space, it could be towards a larger medical firm, and I think the key difficulty. So knowing that is one thing, but getting there is the other difficulty, right? A lot of these organizations operate in very tight silos, and most of the entrepreneurs will have no access to a lot of these areas. I would say in the past 2-3 years, it's gotten better because a lot of organizations have actually started innovation teams, or they've started having a scout-like kind of like entity that allows them to look into the market, and they're more proactive in doing that, right? And that's only because there's actually much more available in the market that they want to get access to. So I would say that most founders, at the very early stages, we have to make it realistic for them to say that, hey, you're going to go generally going to go towards industrial, right? For example, in the areas of mobility, in the areas of industrial sensors and stuff. I think going into industrial is probably the main key. So then now, how do you position yourself, towards that kind of a path? Right? Is it working with the right investors? Is it making sure that you have enough strategics in your cap table to ensure that you have diversity in terms of looking at the different industrials that could potentially acquire you? So crafting that path is going to be different from crafting a path of, let's say, a consumer startup, right? And I think the founders themselves would need to understand that and be ready for that also, because that journey is a bit more painful, and a bit, it's a bit longer. Right, and you have to be flexible in terms of how you adjust the product to fit, some of these industrials also.
Okay, so from your perspective, strategic M&A actually tends to be
Definitely
the most bankable exit path.
Yeah, based on our experience so far.
Okay, any other points of views on this?
No, I'll let the rest say something.
Sure, to the other panelists then.
Yeah.
Sure, I think all of us have a part to make Southeast Asia known to the global stage, including those who are listening in. Like Victor said, having an idea of exit is helpful, particularly for investors. I think if you're working in the healthcare industry, it's also very important, if not more important, to be validating your solution early. And what do I mean about that? Think about validating the solution you're working on with users or payers. This could be, hospital decision makers. It is okay to start with the technology in mind, but I think if you are too absorbed in the solution, you may not understand the problem. So that need to be user and patient centric to think about what their considerations and motivations are. That is particularly important in the health tech medtech space. And also, how to make that technology consumable and usable is, interoperability into the workflows, linking it with existing infrastructure, or is it a point solution on a standalone application? Yeah.
So, Anton, in your position, have you all made a full acquisition of a portfolio company, or of a company that you originally invested in? Is that one of the stated goals of your venture fund?
It could be. It could be towards a path for acquisition if the relationship and the value proposition fits. It could be that we continue developing or building companies who could be long-term commercial partners for the company.
Okay.
I take a slightly I guess different view. Not different, but rather, because coming from a fund with a limited fund life as opposed to our two other investors here who have a more evergreen kind of fund life, right? I have a more I should have a more myopic view towards exit. Like I should be shaping the exit more than my other investors. But actually, sometimes the problem that I see is the other way around, which is great big deep tech startups have great technical guys and technical founders who make for very good acqui-hire targets. And the issue there is exiting too early, as opposed to not having a good exit later on. Because if you're a great company, if you're a good deep tech startup that commercializes well, you can always exit through other means, right? There's of course you get a discount, whatever, but you can always find an exit. But I think if as venture funds that want to that somehow applies the power law of investments, if you have startups that exit too early, that caps your potential and that limits that one or two home runs that you potentially could have had. And I see that in some cases, not in the investments that we made so far, thankfully, but some cases that I've seen that companies, they exit too early before they reach their potential. Because you can imagine, right, a lot of these tech startups, they work with corporates for their first 1 or 2 or 3 POCs. And oh, hey, the solution works. Let's not give this to our competitors. Let's get them over and join our team.
And maybe Maria, just to add on one more point beyond just M&As, the other way that a lot of I would say even especially earlier stage deep tech investors, so we do early stage and growth also, would actually be via secondaries, right? So I think within the market there is a market for secondaries for folks who have tighter fund life, or even for us, we are even though we are evergreen in nature, there is a certain expectation of us being able to make sure that our portfolio is financially viable, right? So I think secondaries are a real way of exiting for the investor, right? And making sure that the founders always have someone better or someone more relevant to assist them at the right stage.
Okay, so let's talk about, I was actually trying to keep the conversation a little bit non-2020 focused, because the moment we start talking about 2020 and what's happened this year, it kind of takes over the whole conversation. But we can't ignore it, right? It is real. Yeah. So let's talk about 2020 specifically. And Sinue, you actually already mentioned this in your introduction, where like funding has been difficult to come by this year. Actually on a global level.
Difficult is under a statement. It's impossible.
Okay. Well, what I was going to say is actually at the global level, I think everybody, had a freak out in Q2 and funding, and there were layoffs and their funding was quite tight. But actually it does feel like the tech community in particular has seen a bit of a resurgence. You can see this on the public markets and such. So what do you think is different about deep tech funding this year, and how it's not following the global tech trends rather?
What is clearly different is that it's not happening.
Okay.
I mean, as I mentioned, there's a lot of herd immunity. If anyone is deploying capital, it's in the small doses. I think Wei Sheng said already, not big investments. So companies are looking at, I would say, beyond 5 million. It's very hard, which is quite interesting, right? Because as an investor, you don't want to buy at the peak of the valuation. You want to buy at the bottom of the valuation. You can find very interesting opportunities for investing now. But again, that plays onto the herd immunity, the uncertainty that we see in the markets. No one really knows when this is going to resume. Yes, vaccines might be available in September, October, but when do they make available? So I think this is playing onto the mind of everyone a bit. We see, however, small investments to support the portfolio, but again, that's like 1 million, 2 million, small things. And as Wei Sheng said, it's a perfect time to invest also, and that is the comfort is there, to very early stage companies, because you are not expecting them to really sell much, you're expecting them to build much, right? So in that sense, I think that is the approach that we're seeing.
Sure, pulling back on deployments for sure. To the investors, I mean, how has your approach to investing changed or not changed this year?
So I think fresh on the minds of all investors, especially when COVID first happened, for us was firstly to make sure that our existing portfolio is sustainable, right? So we want to make sure that runway wise, all our guys were reasonably comfortable. For those that were not comfortable, we need to figure out how we can get them to a point of comfort. But having said that, we will only do that if we believe that the company will come out stronger post COVID. Right, meaning that if I'm funding you for the next 12 to 18 months, but after that you're going to be in a worse off position or in the same position as you are today, then the key question is, are these funds being deployed appropriately, right? And I think the company needs to be able to show that in 18 months, because of this funding, they're going to be in a much stronger position to raise a round, and they're going to be in a good position to do something, right? So there are cases where it's very obvious that these guys are in a developmental phase. In 18 months they will come out really strong and raise a big round, and that justifies our investment. But there are others that where you think, oh damn, in the next 12, 18 months they're just going to be burning through, looking for sales, not being able to find the sales, and I think that is a red flag. Right, then if that's the case, then how do we figure out what's a good compromise in the way we assist the company? So I think that's one, figuring out how to make sure that the existing portfolio is sustainable. In terms of new investments, there are, as Vishen said, there are a lot of good investments to be made, especially now. So it hasn't stopped, right? But to Sinu's point, a lot of it is in the earlier stages, where people are just starting out. So this is a good time to do research and development, and just kind of like just grind it out in the very early stages. The growth ones are a bit more challenging, right? There is a bit of herd mentality, as everyone has shared, in that the best deals will get all the money because everyone takes comfort in numbers. Okay, man, if everyone's going, I'm going into, right? But I do believe that there are some good deals to be had. It's just that valuations will be affected, because of at the later stages how they're able to achieve the revenue that they promise will be an issue. So I think there's a lot of challenges looking at the later stages, right? But having said that, there is some room. We just have to make sure that we are able to convince other investors that this is the right late stage company to be banking on. Yeah, so I think these are the two key things that we've been looking at. Existing follow-on rounds all have been going on. So from the government perspective, there are funds during this time that have been put out to support the companies in Singapore, right? I think that the government's focus first is on not losing jobs, right? So there's a lot of money in the space, but the money has to come. It comes at a price, meaning that you have to be able to justify that a private investor is willing to come in and do the investment with you to make sure that the company is legit. So you're just not throwing money at the company, right? Yeah. So I think there are ways to support, but yeah, it doesn't. Overall, I think activity has dropped by a bit, yeah, and we're hoping that it chugs along faster towards the fourth quarter and hopefully first half of next year.
Okay, great. So we have a bunch of great questions. So let me just kind of quickly cycle through them. So from Luis, the specific question is, what does product market fit for VCs actually look like in deep tech? Like, when do you see that slide and you're like, wow, this is product market fit? What does that slide look like?
Well, usually when there's someone willing to pay some money for it.
But that's just some revenue, right?
No, but that's market fit.
That's market fit.
So any revenue counts as product market fit in your opinion?
So first you need to have someone that's willing to pay. Then you need to figure out how many times can you repeat that process, such that you have an idea of how many people are actually willing to pay. And then if you hit a certain number, then you believe there is some fit. But having one or two actual customers and not POC, not POC revenue, not trial revenue, real revenue, that's usually a good sign that there's some market fit. But depending on which part of deep tech you're looking at, it will vary.
Okay.
But Maria, this is not about a slide. It's not about having an idea. It's execution, right? And what you bring on the table in the very early stages. Okay, I don't have anything. I'm a very motivated guy. I want to do it, and people bet on me that I'm going to do it. But that's pre-seed, right? Then is what have you achieved? You have POCs, you have productions. It doesn't matter where you have a beautiful slide or you present everything. It's like, because then they are going to go to your numbers. And if their numbers don't create that market fit, it doesn't matter. It's execution. This is all about execution.
Okay.
I think the other angle that I look at is also the quality of the revenue. So I think Victor touched on that. The POCs are great, but how does it translate to a long-term, more recurring kind of revenue that's important for us. The other angle that I also look at is sometimes the buyer of the product and the user of the product is different. So what I also look at is going beyond the revenue is also whether the user of the product likes the product, uses it frequently, thinks that it makes a difference in his or her life in terms of the job that he or she is performing. That's important for me. For example, and maybe Anson can add on to this. One space that I really like is in medical AI diagnostics. The buyer of the product is the hospital chain, maybe the hospital director, some person high up, right? But the user of the product could be a radiologist, could be a certified doctor, could be somebody else, somebody who has no clue, who's not signing off the check. So I would check on his or her experience and his or her usage of that product before to determine, what really is the quality of this revenue, because it might not occur next year.
I think that's very actionable insights from y'all. Thank you. Here's one from Jason. How do you approach valuations for earlier stage deep tech companies, pre-seed to Series A? I feel like this is this question is perfectly made for all of y'all.
Maybe I can go first. Pre-seed to Series A, right? Was that the question?
Yes. How do you do the valuation at that point?
There's no metrics. So what I usually do is, first of all, you chart out what is the roadmap, and how, therefore, and if you can, and this goes back to my earlier point on tranching. If your roadmap can be segregated into significant milestones that you and I both agree on, and then we decide together how much money you require to get to that milestone, and then subsequent milestones as well, and then we say, okay, this is the X amount of money that we need to have to get to this milestone, and then it becomes a negotiation on how much dilution you want to take. And this becomes a question on what the exit could look like and how much you could potentially want to own an exit, and kind of work backwards from there. There is no hard and fast rule. I think it's based on these few factors you negotiate. Okay.
Anselm, you were mentioning earlier about the IP rights and then a few other factors that you look at. How does that end up factoring into the overall valuation calculation?
Typically, in the early stages, it would be very difficult to value the IP. I think if you're talking about pre-seed or pre-series A stages, we don't invest in that early stages. But as Wishing said, it will come to a negotiation about both the investor and the founder's perspective of what the potential value of that business opportunity, is going to be realizable out there, what's addressable for them more immediately. Yeah.
Okay. All right.
If I may, Maria, if I may add on the valuation thing. As a founder, you obviously want to preserve your dilution, right? On the founder team. So obviously you want to go for the highest valuation because eventually you're going to do different rounds, right? So if you seed, you're leaving behind 20% of the company, 20% of the company, 20% of every round, right? So at the end of the game, either your company goes very high in valuation, so that the small amount that you keep is worth anything. So basically what you have to do is really understand when, and that ties on to the exit, right? When are you going to exit? How much are you wanting to get out of this? And the rule of thumb is don't give more than 20%. And that gives you the amount of money that is going to, once you have that fixed, you can calculate, okay, if I'm going to raise $1 million, I need my valuation to be, say, roughly 4 million, right? Something like that. And then you have to be very careful, obviously, with the liquidation preference and all that stuff, because the more you give on that space, the more you're going to suffer afterwards. Sometimes you cannot, compromise, and investors will require it. But that becomes a very potentially dangerous value proposition for the cash flow coming to the founder, right, on the founder team. So they need to be very, very aware of this. So it's not just, really, it's not about valuation. Valuation is, again, only a part of the game. Is the terms that are attached to the valuation is much more important. You might get a valuation of 100 million with 5 times liquidation preference that effectively make the valuation 4 million.
Yep.
And maybe I can add one small perspective in terms of, to add on to what Sine and Weishan have shared. One other way to think about it is also, at your current valuation, what is the next valuation that you're attempting to go for, right? And whether or not as a company you'd be able to achieve the right metrics or the right milestones in order to hit the next valuation. And I think that's related to what we're saying about tranching and all that, because then you need to be building the revenue pipeline or your IP pipeline in order to hit that next number, which you need. Yeah, and typically most founders and most investors have a certain number that they are aiming for. Right, so then you need to think backwards, right? So do you want so how do you is it achievable within the 18 months that you have? And if not, then maybe we need to adjust it. Whether is the follow up valuation too high, or is the earlier valuation too high, right? So I think so there's a bit around that also.
Yeah,
and
for sure.
just one more point about that is I think it can become a problem or challenge for later stage investors if the founders are excessively diluted in the earlier stages.
Yes.
Yeah, so we would typically like to see that the founders maintain a significant shareholding in the company, even in the Series C or these stages.
Yes, and early
100%.
stage VCs like us shouldn't screw it up by by having owner.
Very important. Very important.
Yeah.
Well, I think we've seen some global cases of overvaluation. So yeah, that one's much more common sense these days, luckily. Okay.
That's very interesting, Maria, because at the end, the valuation is contingent on it also plays kind of the herd behavior kind of thing. If someone gives you a 500 million valuation for a pre-seed company, no one is going to know the investor most likely in this part of the world. I mean, they all have their, because it's a community, right? So Qualgro comes in and screws it up at the beginning. It's not going to reflect good on them. SGInnovate might not want to invest, and the community might not want to invest. So there is founders think that they have a lot of space. I'm going to get this great valuation. You should try, but you are playing against the system, if you will, right? Because they come in Series A, but then another one has to come in Series B. If this is all out of bounds for the herd mentality, then it's going to be complicated, right? Then is when it becomes also interesting to explore other settings, right? So you go and why don't you raise in the US and complement what you raise in Singapore? Because maybe you get higher valuations there, and eventually at some point that's why you need to go to Middle East or whatever, right? So, and that plays to what Wayne Seng said before. You need, being in Singapore, you need to have a global mentality, not just for customers, for everything, for your fundraising as well.
Okay, I'm gonna try to get through 2 more questions.
Sorry about that. No.
It's a good conversation. Honestly, I think the conversation about valuation and specifically dilution on the founders front is actually it's not that talked about, and it should, because it ends up really mattering to setting up a proper cap table that enables you to succeed. So it's good. All right. From Catherine, there's usually a lead investor in fundraising. What's your advice to finding that lead? And let me supplement this by saying, if you're a deep tech founder, should you go to specific funds that have a deep tech focus, or can you find a lead or any investor from from a more general fund? Sinue? Do you only raise funds from deep tech funds? And how do you find a lead?
Okay, the first thing, if you don't have a lead, you don't have a round. That's it. There is a lot of investors. There is a lot of money, but having a lead is the most important. The lead is the one that is going to set the terms, is going to provide the comfort for the other investors to come in. Why is so important? Because they are the ones, rolling their sleeves the most and understanding up to some extent, to however deep they can get, what the company is and what the company is doing, what is the competitive advantage. So then the rest will follow. And finding followers is easy. If you look at the landscapes, you look how many leader VCs are there out there. Not many, not that many. There are many followers, but not that many leaders. And then, especially in deep tech, if you are able to find a lead investor that is non-expert on whatever field, then the question mark is, how trustworthy is that investor in respect to other investors that they are going to follow and put money there? And again, that complicates the game very much for the founders, right? Because you think you have a universe of investors. Every VC is a potential investor, but the reality is that only the lead investors are the ones that are very interesting for you. And of those subset that is, that has the ability to understand your company and has the trust of the other ones. So at the end, the universe compresses very much. And that, again, that's why you probably need to start exploring outside as well.
Okay. Any other perspectives on this question?
Yeah, Ben, quick one. So maybe, find an investor that can provide the value you need to get your next financing. I think it may or may not be a deep tech fund or a strategic, depending on where you are. But of course, there are merits to having a deep tech investor or strategic because, they are more familiar or understanding with what you are doing. But other than that, understand that value in the nearer term with that investor in your cap table.
And have an assortment, right? Meaning that you need to go in at different stages, go in with the investors that are most relevant to what you need in terms of support, right? So beyond money, because there's a lot of money, but in terms of like what can each investor provide, like a corporate strategic, a government strategic, a private fund, or even just dumb money, just money. Money for money's sake, right? So sometimes you need a bit of that too, because the rest may not have that much firepower, right? So you need a mixture of money within each round that powers your individual needs.
And I would say just a practical advice for startups raising with VCs, talk to other companies that they have invested in to find out whether what they say is whether what they promise is what they did, and in being a part of a cap table, because lead investors tend to not always be working very close with you, especially at the early stage. Maybe be on your board, there's some discretion over some decision, not discretion, but rather some influence, maybe, if you will. And you don't want somebody who is overbearing, nor somebody who is completely off, hands off, right? So if they say they do something, the best way to check is with the other companies that they have invested in.
Okay, and my last question, and Jody, I'm sorry for running over, but I think it kind of ties back to what we've been discussing. So Victor, you mentioned that strategic M&A is usually one of the best exit opportunities for deep tech startups, especially in this region. So would your advice be for people to start building out those strategic alliances and seeking out potential industrials as their customers from as early on as possible within their journey?
So definitely, I think the moment you have an idea of so this relationship starts super early, because you need to also validate at some point that there is product market fit, that someone actually wants to use your product, right? So having that discussion earlier on would help to understand whether what, because there is a certain gulf between the researchers academically and the actual practical applications of the technology, right? So sometimes having a real sounding board across multiple organizations may help you to fine tune your product. So definitely at the early stages for sure, and as you start building up, making sure that you understand what are the specific needs and wants of the organization at that point in time, because it changes, right? Like right now everyone is like COVID crazy, right? So anyone with some a sliver of COVID relevance will figure out how they can fit into what a corporate is looking for. Can someone do 10,000 swabs a day, right, at the fastest, most non-intrusive way? That's a real. Some people are actually looking for that, right? So I think knowing what the customers want will help you to get to a product much faster, and then definitely will help you to develop the surrounding technologies even quicker.
Okay, great. So on that note, thank you to all of our panelists and attendees today for such an enlightening discussion. I definitely learned a lot and I thought it was super interesting. So thank you so much for sharing all your insights. There are a ton of pieces of wisdom to take forward for everybody, hopefully both whether you're on the deep tech founder side or on the investor side. And hope that some of the tidbits that you picked up today you can take forward and help make the navigation of the overall process a lot easier going forward.
Thank you, Maria. Thanks, Anselm, Sinoe, and Wishing.
Thanks, guys.
Thank you. Thank you so much.
Oh, thank you, Maria, for moderating the exciting panel discussion. And also special mention to the rest of our panelists, Anselm, Sinoe, Wei Sheng, as well as Victor for joining us this morning. And we hope that we've managed to cover the insights as well as unpack more about deep tech investing across the different profiles of our panelists in today's webinar session. For our attendees, please keep a lookout for our post-event EDM, which will include a recording of this event that will be posted on our SGInnovate YouTube page. Please also feel free to write to us at events@SGInnovate if you have any questions. And we will also appreciate if you could drop us your feedback after this webinar using the post-event webinar link. We do hope to see you at the rest of our future events. And also, everyone, please have a great day ahead. Thank you so
Thanks,
much.
Jody.
Thank you.
Bye-bye.
Bye, everyone.
Bye.
Bye, everyone.